To start shorting stocks on Robinhood, you need to understand the basics of short selling. Short selling is a strategy used by investors to profit from a decline in the price of a stock. It involves selling a stock you do not own with the expectation of buying it back later at a lower price to realize a profit. First, you need to enable margin trading on your Robinhood account. This can be done by going to the account settings and selecting the option to enable margin trading. Keep in mind that margin trading involves borrowing money from Robinhood to buy or sell stocks, and it can be subject to higher risks and fees. Once you have enabled margin trading, you can start the process of shorting a stock. Begin by searching for the stock you want to short in the Robinhood app or website. Once you have found the stock, select the trade option and choose sell. Since you do not own the stock, Robinhood will lend you the shares to sell. The next step is to set a limit price for the short sale. This is the price at which you want to sell the stock. For example, if you think the price of a stock is going to decline from $50 to $40, you can set a limit price of $50. When the price reaches $50, the short sale will be executed. After the short sale is executed, you will need to buy back the stock to close the position. This is known as covering your short. You can set a limit price for the buyback. For example, $40. When the price reaches $40, the buyback will be executed, and you will realize a profit of $10 per share. It is essential to keep in mind that short selling involves high risks, and you can lose more money than you initially invested. If the price of the stock increases instead of decreases, you will incur losses. Therefore, it is crucial to do your research, set stop-loss orders, and monitor your positions closely to minimize potential losses. In conclusion, shorting stocks on Robinhood involves enabling margin trading, searching for the stock you want to short, setting a limit price for the short sale, and buying back the stock to close the position. It is a high-risk strategy that requires careful planning, research, and monitoring to avoid significant losses.